Most candidates answer private equity versus private credit like a definition question. That is why they sound average. In interviews, the better answer is not equity means ownership and credit means lending. The better answer is here are the 5 accounting workflow differences I would check. Let's use one case. A private equity fund invests $10 million dollars for a 40% stake. A private credit fund lends $10 million dollars at a 12% annual cash coupon. Same amount, different instrument, different accounting workflow. Difference 1. What asset is created? In private equity, the fund records an investment in a portfolio company. The accountant tracks cost, ownership percentage, deal documents, and valuation basis. In private credit, the fund records a loan asset. The accountant tracks principal, coupon, payment dates, maturity, security, covenants, and repayment terms. So the first interview line is simple. Same cash leaving the fund does not mean same asset on the books. Difference 2. What happens at month end? In private equity, there is no automatic monthly income just because the fund still owns the company. The accountant mainly monitors fair value and dividends if declared. But in private credit, the loan has a contractual coupon, so interest must be accrued. $10 million dollars times 12% divided by 12 months. That is $100,000 of interest for the month. The entry is debit interest receivable, credit interest income. This is a key interview point. In private credit, income can affect NAV before cash arrives. Difference 3. What if the cash does not arrive? This is where the interview becomes practical. In private equity, no routine cash may be perfectly normal. The company may be reinvesting, growing, or preparing for exit. But in private credit, missing cash triggers questions. Is the interest still receivable? Is pay in kind interest allowed under the agreement? Is the payment overdue? Should the loan be reviewed for non-accrual or impairment? Many candidates make the mistake here. Unpaid cash interest is not automatically pay in kind interest. Pay in kind must be permitted by the loan agreement. If it is not permitted, the issue is collection risk, not automatic pay in kind accounting. Difference 4. What does the accountant monitor after investment? Private equity mainly tracks value creation, ownership, fair value, portfolio performance, corporate actions, exit planning. Private credit tracks repayment capacity, outstanding principal, accrued income, cash interest, pay in kind income, covenants, arrears, prepayments, credit deterioration. That is why private equity feels like a valuation and exit workflow. Private credit feels like a yield, repayment, and credit risk workflow. Difference 5. What does the next cash event mean? In private equity, the next major cash event may be an exit. The fund receives sale proceeds, removes the investment from the books, and records realized gain or loss. But exit proceeds are not automatically realized gain. You compare proceeds with carrying value and consider earlier unrealized gains already recorded. In private credit, the borrower may pay interest. That clears the interest receivable. The borrower may repay principal. That reduces the loan asset. Principal repayment is not profit. It is return of the loan amount. The income is the interest. Now connect this to investor reporting. Both funds calculate NAV, but the NAV drivers are different. Private equity NAV is driven by fair value, realized and unrealized gains, exits, distributions, DPI, TVPI, and carry. Private credit NAV is driven by accrued income, pay in kind income, outstanding principal, repayments, prepayments, credit quality changes, non-accrual indicators, and impairment. So here is the interview answer. If I move from private equity to private credit, I would not only change the journal entry, I would change the workflow I monitor. Private equity follows ownership, valuation, exit. Private credit follows principal, yield, repayment, credit risk. That is the difference interviewers want to hear. The workflow changes because the instrument changes. Now test yourself. If $100,000 of cash interest was due but no cash arrived, what would you check first? Interest receivable, pay in kind permission, overdue status, or impairment indicator? Comment credit if you want the journal entry version next. Subscribe to the Fund Desk for more fund accounting interview cases.